You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, Characteristics and Risks of Standardized Options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. OIC offers a variety of resources to those interested in learning more about options, including live seminars, webcasts, and podcasts. Check out www.optionseducation.org for more information. Now here's your host, OIC's Director of Retail Education, Joe Burgoyne.
Welcome to OIC's Wide World of Options. Thanks for joining us for today's show. Let's get started first with Strategy Spotlight.
It's time to break down the latest option strategies. It's time for Strategy Spotlight.
Joining us on Strategy Spotlight today is Dan Passarelli. Dan, thanks for joining us.
Joe, thanks for having me.
Now, before we get started with our conversation on Skew, Dan, how about if we let our listeners know something about you? That's probably a pretty good place to start. Now, I know you spent a number of years, on the CBOE as a market maker, and now for the past 5 years, you've run your own company, Market Taker Mentoring. How about if you tell our listeners about that and as also the 2 books on options that you've written?
Sure. Well, when I was down on the trading floor, I was approached by the CBOE, and they asked if I wanted to teach classes for them, and kind of wasn't sure at first, and ended up teaching classes and found that I love it. I love being able to give back to the trading community as an educator, and ultimately that prompted me to start Market Taker Mentoring, where I teach retail and professional traders how to trade options, both basic, intermediate, and advanced strategies. Teach one-to-one classes. We teach group classes. We have a couple newsletters, and that's what I've been doing. The books I wrote, the one you guys probably are familiar with, the popular one is Trading Option Greeks.
Yes, excellent book.
Well, thank you. That's now in its 2nd edition, and the second one, the more recent one, was The Market Taker's Edge.
Well, I know that they are both really well-respected writings, so congratulations to you on that.
Thank you, sir.
Now, when we get into Strategy Spotlight, the way this works is, I reach out to you and you come back to me with the topic that you'd like to get into for our listeners. And Dan, you came back with the topic of Skew. How about if we start by, maybe you explaining why you chose Skew, what it is, and then, how you actually define Skew.
Skew is one of those things that unfortunately fly under the radar for a lot of newer traders. It's a little bit more of an esoteric concept, and it's a little abstract as well. People's brains, I think, are not used to thinking in the abstract way that is required to fully understand Skew. But here's the thing. Skew is really help traders get an edge and put on statistically better trades and put on trades that have what us traders call edge. And that's kind of what it's like with a lot of things in option trading. The more complicated it is, the more it can help you lead to profit if you put in the time to understand it.
So how would an investor, start, when it comes to Skew? Where does somebody who, as you say, this is a little bit more of an abstract, esoteric approach. How does, the regular retail investor approach Skew?
Well, you start out by understanding volatility and what that is, and just kind of in a nutshell, implied volatility is the relative expense of options. Are the options cheap or expensive? That's what implied volatility tells us. Now, any one given stock that has options listed on it doesn't just have one implied volatility number. Every single option has its own unique implied volatility level, and that's what Skew is. And when you understand that, and you can master that, now you really kind of have a leg up on your competition, the people who don't understand that, because you can use that to buy the cheap options and sell the expensive options, and that sort of puts the odds in your favor.
How about if through an example, OIC's favorite stock, of course, is XYZ. Maybe with a couple different strikes and months, can we talk about potential Skew in the marketplace?
Certainly. So good old XYZ stock, a stock I've made millions on over the years. That stock would have different strikes listed, different months listed. So there's basically two types of Skew. One is the strike Skew and one is the month Skew. So let's start out with the easiest one to understand, the monthly Skew. Maybe there are the September options listed on XYZ, and there are the October options listed on XYZ. Now, if, for example, the September options that have a shorter time period until expiration are trading at, say, a 50 volatility, and the October options, they have 2 months until expiration, a little bit longer period of time, their volatility is trading at 40, a 10-point difference. Well, what a clever trader can do is buy the August options at a 40 volatility and sell the September options at a 50 volatility, and therefore put on a time spread in which the option that trader's buying they're buying the cheap one, and the option they're selling is the expensive one. Now, this intuitively is what any trader wants to do in any situation.
Sure.
Any business person. Buy things that are cheap, sell things that are expensive. But, here again, the problem with a lot of new investors is they don't even know to look for this. They heard of a time spread and they put it on, and, a lot of times they end up doing it at a disadvantage where they're buying expensive options and selling cheap ones, and they're, maybe the trade works out, but they're not getting paid as much on their winners as they should, and they're losing more on their losers than they should. So this is really what the smart money does. They buy those cheap options and sell those expensive options.
Now, there are other factors, of course, that come into play. I mean, in your example, you've got October at 40 and September at 50 implied. Potentially the earnings are in September. So maybe there's justification for that premium in the implieds in September. How does an investor know? Is there a black and white answer?
Yeah, there's nothing black and white when it comes to option trading, that's for sure.
Correct.
But, traders have to appreciate the context of our conversation here. We're kind of assuming, I'm kind of assuming in my discussion here, that you know what a time spread is. You know all those basics. Hey, for a time spread, I want the stock to be between the break-evens at expiration. I know that if the stock moves too much, I lose money. That means I got to make sure earnings is not coming out during the life of the short-term option. I've got to make sure there's no other expected volatility events. So this discussion we're having about skew, it's sort of the next iteration of your thought progression. I'm going to take this one extra step that gives me a bona fide intellectual and statistical advantage.
I like it. Now, you talked about another type of skew. You talked about strike skew. Talk to me about that.
Right. So we can do the same thing. Maybe that same XYZ stock September options, maybe the strikes that are lower than the at the money, maybe they're trading at, say, a 55 volatility, and the strikes that are higher than the at the money, maybe they're trading at 45 volatility. You're just kind of making up some numbers here for example purposes. Let's tighten that up just a little more. Say the 55 calls, they've got that 54 volatility, we'll say, and the 45 calls, maybe they've got a 47 volatility. Well, what a trader can do is sell a call credit spread where the trader sells that higher strike call, the lower one, and buys that cheaper call that has the lower volatility at that higher strike. So, you put on a call credit spread, and now you're kind of doing the same thing that I described with the time spread, where you're not just putting on a credit spread, you're going through that same thought iteration. Okay, I need the stock to stay below this point at expiration, but I'm only going to do that if I can sell expensive options and buy cheap ones to further give me a little extra on my winners and lose a little less on my losers and give me a little bit more favorable of a break-even point.
And this skew advantage, if you will, is driven by the pricing models, correct?
Right. Well,
to a point?
To a point. It's observed by using the pricing models. What it's really driven by is the market. When options get more expensive, they get more expensive for the same reasons anything gets more expensive, because people want them. It's good old-fashioned supply and demand. When people want to buy options and they go into the market and they place their bids and they buy up those options, it drives the price higher. When people sell options, that drives the price lower. It's if you've ever had a high school economics class and observed a supply and demand curve, that's what it is in reality, just right there in place. You can see that in the market if you're looking at the volatility.
And that's a great thing. I think that's why both of us love the options market so much, is because it's so dynamic. It is live. It is a living and breathing marketplace of prices, and as you say, driven by the all important supply and demand factor.
Yeah. Options are. I think the reason that I've been able to stay passionate about them for the last 20 years is because they're intellectually stimulating, that's for sure. There's always something you can keep digging deeper and deeper and deeper, and it's really a fascinating instrument.
They really are. Now, let me ask you, we've obviously got calls and puts. I assume calls and puts both have skew, but is there any difference between the two?
We can talk for a long time about this. Basically,
we've only got 2 more hours.
Yeah, I'll talk slow. Basically, the answer to that question starts with the assumption that call and put volatility should be pretty similar. That is, the calls and the puts within the put-call pair, that is, say, for example, the March 30 calls should have about the same volatility as the March 30 puts. And that, of course, is because they're substitutable instruments given the math involved in the put-call parity.
Let's if you don't mind, let's hit that again. How about if you tell our listeners, a little bit more about this whole aspect of call-put parity?
Sure. So there's a formula out there that's actually one of the options math formulas that's not really that complicated. I don't know how to derive the Black-Scholes model, but I can show you what the put-call parity is. It's one of the things. I've got a couple of chapters in Trading Option Greeks that explains that. And it starts with the assumption that basically a put is a call and a call is a put.
What? Say that again. Huh?
Sure. A put is a call and a call is a put.
And you wonder why when we're out there talking to investors who are new to options and we give them something like that, we wonder why their eyes, roll back into the back of their head, huh?
Indeed we do. But it's something that definitely can catch somebody off guard when they first hear it. But if you've taken just the basic options class, you probably know this, but you don't realize you know it. If you look at just the simple hockey stick profit and loss diagram of a long call and compare that to the identical looking hockey stick shaped profit and loss diagram of a stock with a put, a protective put, they look the same. The risk is actually the same. So I could choose to buy a call, or I could choose to buy stock along with a put, and I have the same risk. I can only lose so much on either of those investments, and I can have unlimited profit on either of those investments. And looking at the profit and loss diagram and just intuitively listening to what I say, it makes sense on the surface. But put-call parity holds that math together. Put-call parity ensures that you would lose exactly the same amount on either of those two trades if the stock goes against you, and you would make exactly the same amount on either of those two trades if the stock goes in your favor.
Good explanation. And, for our listeners whose eyes have rolled to the back of their head, it's not because of Dan's explanation. It's just because, just getting started in the option space, some of these concepts that frankly aren't that complicated can be confusing. So, listen to the show again, Google call put parity, but it's an important concept that you should try to get comfortable wrapping your head around. So Dan, I think, you touched upon it a little bit earlier with the one example of the calendar spread. How should investors, use Skew? I mean, is it really just about trying to take in that theoretical edge, through different option strategies?
Yeah, that's at the heart of it. So again, we start with that assumption that you need to look at volatility on every single trade and only buy options when they're cheap and only sell options when they're expensive. And then we're going to start with the other assumption that you typically trade spreads more often than outright options because spreads offer you limited risk, and you can often have a more favorable trade when you trade a spread than simply going out there and buying a call or something like that. And so when you have those two assumptions, using volatility and trading spreads, you realize, well, if I'm buying one option and selling one other option, I should only do that, only put on any spread when I can buy the cheap option and sell the expensive option. Now, there's a couple of exceptions to that rule. For example, when we get into vertical spreads, you would never put on certain spreads if you adhered exactly to that. But, again, this is one of those things where like I said before, you can just keep scratching below the surface and get more and more complex. And, some of these spreads where the skew is almost always against you, you can sort of violate that rule that I just said. And, maybe trade it when the skew is more in favor or, than it typically is, I guess I should say, or less against you than it typically is. Skew is one of those things that, given my explanation a minute ago, even a typical retail investor who has only been trading options for a short period of time can use it to trade better. And it's also one of those things that professional traders like market makers pour over every single minute of their trading and look for the skew to change slightly to give them more of an advantage or less of an advantage and capitalize on that. And no kidding, trade the skew.
Well, and I hope I'm not beating a dead horse, but you have referenced cheap versus expensive options, a few times in our conversation here. Can you one more time just define for me, what cheap means, and does cheap always mean, a particular option in one underlying versus the other options? Is that what we're talking about? One option versus another?
Yeah, I mean, well, it's very relative, I mean, just to kind of hit one more time on the concept of implied volatility and exactly, well, how does that really work? How is it cheap or how is it expensive? Think of options as insurance policies, which of course they are. I can buy a put to insure my stock, and like any other insurance policy, the premiums are not standardized. They're not the same for every situation. Somebody who is 40 years old, drives a boring car and lives in a boring neighborhood probably has pretty low insurance premiums. If you've never had a ticket before, you don't pay a lot.
Exactly.
But then a different kid who's 18 years old and just bought a beat up red sports car and has 12 tickets in the past month, he's going to pay a lot, right? Because the insurance company perceives higher risk. Well, that's how it works with options. When the market, the people who write these insurance policies or sell these options, when they perceive higher risk, they basically raise the insurance premiums. And that happens through a much more efficient, transparent system than it does with insurance policies. It's the market supply and demand setting those prices. So that's how and why the options are more cheap or more expensive. Now it becomes relative, okay? A stock that really moves around a lot, I mean, its volatility is probably never going to be 12, it's always going to be something higher, but then it fluctuates and gets relatively cheaper or relatively more expensive.
Right.
Some other stock like, I don't know.
XYZ.
Good old-fashioned XYZ, for example. If XYZ has been in a range for the past, 10 years between 50 and 51, its volatility is not going to be 72. Its volatility is going to be really low. It's going to be 10 or something like that. And maybe it can bump up to 11 or bump down to 9 and become relatively cheaper or more expensive for itself compared to itself. And that's what we're talking about. That's what we're looking at. And you can observe this by simply looking at a volatility chart of any given stock.
Where would you find that?
If you have an options-friendly brokerage account, they probably offer that to you. It's called a volatility chart, and you can go back and look at the implied volatility over any given period, just like you would with a stock chart, 6 months, a year, or longer. I prefer to look at volatility charts over about a 6-month period. Any further than that, it becomes a little bit less relevant.
Okay.
But yeah, that's how you can observe that relative fluctuation in implied volatility. Is it cheaper or more expensive than it used to be?
I think that's really a great way to wrap up our conversation. I mean, this whole idea of our listeners and investors going out and using the implied volatility charts to get a sense for whether their option premiums may be, cheaper or more expensive. Before we wrap, Dan, 2 choices for you. A few words of wisdom for our listeners, or a good story from the pits. How would you like to wrap it up?
Well, let's see. I guess it probably benefits people more if I give a few pearls of wisdom here.
Good choice.
Thanks. If you don't look at Skew right now, now is the time to start. This is a short radio show. We've talked here for 20 minutes or whatever it's been. I wasn't able to tell you every single thing I know about Skew, but hopefully I was able to give you enough to plant the seed in your head as to why it's so important and the advantages that it can give you. Your homework what you need to do to be a better trader and potentially be more profitable is to go out and learn more about Skew. And there's many resources out there. I mean, you can simply go out and Google option Skew, and there's a trove of information out there. Your homework is to go out there, learn more about it, and become a better trader.
Outstanding, Dan. Well, thanks so much for joining us today. And that'll do it for today's Strategy Spotlight with Dan Passarelli.
It's time to meet the movers and shakers from the world of options. It's time for Profiles and Perspectives.
Okay, joining us on Profiles and Perspectives today is John Bullock of TradeStation. Hello, John.
Good morning.
Thanks for joining us here today. How about if you tell our listeners how you started in the business and how you landed up at TradeStation?
Oh, okay. Well, thanks for having me, Joe. Basically, straight out of college, I began as a broker trainee. Basically, was a stockbroker for about 5 years. I ran a book of clients. And then in 1997, I had an opportunity to join with a bunch of innovative fellows from the industry, and they started their own online brokerage firm called Online Trading out of Boca Raton, Florida.
And that was back in 97.
Back in 1997.
Right.
We were one of the first official companies to offer the retail client opportunity to trade in the pre and the post markets using an Instinet terminal.
Okay.
I started the trading desk over at Online Trading. From there, we merged with a company, Omega Research, in 2002, and we became TradeStation. And 15, 16 years later, I'm here today. So it's been a pretty nice, exciting ride.
Yeah.
We started as a small infancy company, and now I believe we're number 7 in the world for online brokerage.
Fantastic. So that was the combination of online trading and Omega Research.
Correct.
Turned into TradeStation.
Exactly. Yeah. Basically, what the synergies there were, online trading had the execution part of the business.
Right.
Omega Research offered the software, the analytical part. We put the two together onto one platform, basically forming a double revenue stream, and that's TradeStation.
Fantastic. I have been down to your beautiful offices down there in Plantation, Florida, I believe.
Correct.
Fantastic. Well, how about tell me about the team you work with and some of the things that you now do over there at TradeStation?
Sure, Joe. I'm currently the Vice President of Trade Operations. I currently oversee a team of 17 people. Our team consists of former market makers, brokers, back office personnel. My role involves real-time risk management, overseeing TradeStation clientele and their trade activity. I'm also responsible for some of the reporting and the compliance issues, regulatory stuff that goes into the trading day.
You're wearing a lot of hats.
A lot of hats, a lot of real-time involvement. Basically, with what we do at TradeStation, we allow our clients to trade many asset classes, so we're connected to many different venues. And I'm basically responsible as well to make sure that all of the venues are up and running, that we're not having any connectivity issues, what have you. And if we do have an issue, my team has to respond on a real-time basis and we basically deal with whatever problems come up throughout the course of a day.
Right. And well, as a longtime trader myself, I know how the access to the markets has so dramatically increased over the years.
Correct.
I mean, for our listeners, and when I'm, out speaking, at retail events, I just try to emphasize the access is so spectacular to the options market in this day and age. It's really, you hit that button and, a few seconds later, you got a report. It's remarkable.
Yeah, I mean, especially in the options world, only a few years ago, there were, 3 or 4 exchanges that you had access to trade on. Nowadays, if I'm correct, we have 11 or 12 option markets.
Exactly.
So
yep.
There's so many different choices out there for the retail investor to have access, to trade on these days. And
it's exciting.
It's very exciting.
Now, tell me, you mentioned the retail investor. Is there a particular type of client the TradeStation is, after?
The typical TradeStation client is they're more engaged in their trading activity. Typical trader at TradeStation averages between 50 to 100 transactions a month. Many of our clients will sit down in front of the platform for the entire day and monitor their account and trade their activity. Trade their account throughout the day.
And you have clients from all over the world, don't you?
All over the world. We currently have offices. We're based in Plantation, Florida. We have offices in Chicago, Richardson, Texas, London, over in the UK. About a year and a half ago, we purchased a company out of Salt Lake City, Utah, IBFX. And they specialize in currency trading, Forex trading. So right now we probably have clientele in over 150 countries throughout the world.
Yeah, that's covering the globe. Well, here we are at OIC's Wide World of Options.
There you go.
So thank you very much.
All right.
I know you guys launched a new options platform a couple years ago. Do you want to tell me about that?
Sure. Basically, the new options platform is called OptionStation Pro, and it's truly exceeded all of our expectations. What OptionStation Pro allows the retail option trader to do, it gives them more flexibility when trading options. A couple of the features that OptionStation Pro includes are 3-dimensional charting and the newly released Spread Master functionality, which allows the option trader to mix and match any type of multi-leg option strategy that they so desire. Basically, we're giving the tools to the retail option trader. Everything that they want is right there on one platform for them. Right. So now it's up to them to take those tools and utilize it in their trading.
Right. I mean, if it's anything like me, I got the computer in front of me and I use 5 or 10% of it. And,
yeah, exactly. Exactly.
You just have to invest that time. I mean, I've only been on the platform a little bit, but I have heard many wonderful things out on the road about, this new platform, the TradeStation launch.
Yeah. I mean, we're very excited about it, and so far so good. We really think this new Spread Master functionality is what is going to set us apart from some of the other option trading platforms out there. So we're very excited about it.
Is that sort of like a complex order, delivery system?
Basically, yeah. I mean, it gives you the ability to, like I said, mix and match. You can drag and drop different components of a spread. You could create a 4-legged spread, a 6-legged spread, even an 8-legged spread if you so desire.
Yeah. Why would you? No, I'm kidding.
I don't know why you would, but there's some people out there that they have a condor position on. They want to roll it out to the next month.
Yes.
We'll allow them to close all 4 legs of the condor, open up all 4 for the next month, all in one order. So.
That's dynamite.
Yeah.
Again, that between the functionality and then the access to the markets, it really is a fantastic time for the retail investor.
Exactly.
How about, are there any other products or things you'd like to discuss, from TradeStation?
Well, yeah, as I mentioned, aside from options, we also specialize in equities trading as well as futures and Forex trading. Those are our four main asset classes that we offer to the retail investor.
And do a lot of the investors trade multiple asset classes?
Yes, they do.
Right.
Yes, they do.
Very good. Well, John, it's a pleasure to talk to you. Anything more in terms of the history of the firm or before we wrap it up? TradeStation,
we started basically, Omega Research was the original company.
Right.
Our founders, Ralph and Bill Cruz, back in the early 90s, two young guys straight out of college were opened a couple brokerage accounts. They wanted to start trading equities and options, and they were looking around trying to find a platform or an application that they would be able to do their trading on. And unfortunately, they could not find what they were looking for. Mm-hmm. So they basically created Omega Research. They took different analytical tools, basically started with strategy automation, back testing your strategies. The goal here was to test your trading strategies ahead of time before actually putting any of your trading capital at risk.
Makes a lot of sense.
Yeah. At the time, very innovative.
Yes.
There was nothing out there like that, and that was the format for the first platform. And from there, Omega Research was started, I believe, in 1991. And from there, it just grew and grew. And here we are today.
Well, it's a great story. You guys continue to really help the market with your advancing technology. And really, thanks very much for taking the time to join us today.
Oh, thanks for having me, Joe. I appreciate it.
Thanks, John.
It's time to upgrade your options toolbox with cutting-edge trading platforms, devices, and information. It's time for tools, resources, and good reads.
Today's tools, resources, and good reads is going to focus on a few absolutely fantastic offerings from the OIC. No matter your level of options expertise, the OIC website, optionseducation.org, has something worthwhile for you. I want to focus on the MyPath assessment program. Jump on the site, register, and take a quick 3-minute, 20-question assessment, which will allow us to gauge your level of expertise. Based on the assessment, we'll then download different option courses for you to work on. The course levels are Fundamentals 1, Fundamentals 2, Intermediate, or Advanced. There are courses for everyone, and one of the great things is you can start and stop your progress of learning according to your available time. So remember, MyPath at optionseducation.org. Now, the resource for today is the OIC Investor Services Group. Option professionals are on hand 5 days a week to answer all of your options-related questions. You can call them at 888-OPTIONS between 8:30 and 4:30 Eastern Time on Mondays and 8:30 to 6 o'clock p.m. Eastern Time, Tuesday through Friday. You can also reach them by email if you prefer at options@theocc.com. The group takes a lot of pride in handling all investor questions. Finally, today's recommended good read is Technical Analysis of Fundamental Markets by John Murphy. It's over 500 pages of clear insights on technical analysis. Consider checking it out. That's today's tools, resources, and good reads.
It's time for a nostalgia break. It's time to take a look back.
In today's Looking Back, we'd like to take a quick look at how the listed options market fared in 2013. Well, despite a relatively low volatility environment, the U.S. listed options industry had its second busiest year ever, with just under 4.2 billion contracts cleared by the OCC. That averaged out to about 16.3 million contracts a day. That's a 3% increase over 2012. 2011 still stands as the busiest year ever for listed options, with 4.6 contracts cleared. Options volume soared in the summer of 2011 when the U.S. lost its AAA credit rating. 2013 was the third consecutive year the options industry exceeded 4 billion contracts cleared and traded. Now, two areas of innovation in the industry that helped options volume in 2013 were weekly and mini options. The minis were launched in March of 2013 and represent 10 deliverable shares of the underlying as compared to standard options, which represent a deliverable of 100 shares. By the way, minis are listed on just 5 securities. Now, another product that delivered growth for the industry were weekly options. This pilot program that continues to expand now incorporates over 300 underlyings. With regulatory approval in late 2012, the industry began extended weekly listings in 2013. The extended weeklies allow options to be listed for 5 consecutive weeks. Now, it should be pointed out that no weekly options are listed when standard options exist. All in all, 2013 was a very good year for U.S. listed options, especially given the low volatility environment. That's today's Looking Back.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you heard on today's show, email Joe Burgoyne at options@theocc.com. Or you can call OIC's Investor Services at 1-888-OPTIONS. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu. Or join their group on LinkedIn. Thanks for listening, and be sure to check out our next episode of The Wide World of Options.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.